Hey, Bastian. We got a few more that'll be coming in here pretty quick. We just finished up the other call, so.
It's good. How are you doing, Jim?
I am peachy keen, buddy. Thank you for asking.
Perfect.
Okay.
Hello again.
Shaka, shaka.
Hi, Shaka.
How you doing, Sebastian?
Doing well, thanks. How about yourself?
Hey fellows, how you doing?
Hey, Taiwo.
Yeah, hi. Jim, how you doing? Shaka, it's been a while, huh?
Yeah, I've been.
How's it going with what's that company you're working with again? GOB.
Yeah, everything going good. I mean, you know, we still working through COVID, of course. So, but yeah, everything going good.
Oh, good. That's great. Okay, you know, I'm gonna just go on mute for a while. I'm trying to do a couple of things, but anyway, yeah.
So it's good to see you here tonight, Towel.
Yeah, hi. Yeah. Jim, thanks for inviting me. I love that.
No problem, man. I look forward to, I hope that you can be on the call tomorrow night.
Oh yeah, tomorrow night. Okay. Oh yeah, yes. I'll try to do that. Yeah.
And then right after that call, I'll send you an invitation through the Slack channel.
Awesome. That sounds good. Brandon, how you doing, man? Oh, he's on mute. Okay, I'm going to go mute. I'm just trying to.
Hey, what's up, Taro?
Yeah, hi. Nice. Okay.
Okay, do we want to wait a couple of minutes before we get started, or we want to jump right in? It's already 6:02. So I'm ready.
I'm open.
I'm ready.
All right. If anybody else joins in, we'll just admit them. And we kind of had an outline. Bastian, did you set the outline for the format, or Davida, did you do that?
Do you mean the meeting agenda?
Yes.
I mean, in my mind, I just keep it static, using it at the same time with the flexibility of deviating however the conversation goes. So
Okay. All right. Well, then let me give you the screen share.
Okay.
And it's all yours. Take her away.
perfect. Let me just figure this out here. All right, can you guys see my screen?
Yes, we can.
Perfect. All right. So apologize if I don't look at the camera. I'm working off the bigger screen here. So so what I was thinking for this meeting, since Pat set the bar pretty high last time, I'm using a slightly different approach. So first of all, I don't have any sort of LOI submitted right now or any deal under contract. That's why I decided to go with a deal that the most recent deal that I analyzed. And I want to do the following few things. So the first of all, I want to give you a quick snapshot of one of the markets that I'm looking at, which is Tampa. So you get some sort of a feel of what's happening in Tampa. I'm not going to spend too much time on it, but just to give you a brief overview. Then I'm going to dive into a specific deal that I analyzed. I want to walk you through the assumptions and just the thought process behind it, how I came up with some of the numbers. And then thirdly, I'm using a different model than probably a lot of the other folks out there are using. I'm using Justin Keevel's model, and I know.
And you want to see is the underwriting with Justin Keevel's model. If you're busy, that's fine too.
And So I know a lot of, I was approached by a few people because they're not familiar with Justin's model. So I would just want to give you, as I'm walking you through the assumptions, I also want to give you a tour on how his model works. And I just have to give you a heads up. I'm using a modified version. So I added a bunch of stuff to his model to just make it a little bit more compatible to what I'm doing. So just bear in mind, what I'm showing you today is not necessarily Justin's model. It's a version of it. So let's dive into, well, let me give you first a little bit of I guess, introduction, who I am for the people I haven't spoken with, which most of the names are familiar. But so my name is Bastian Knoise. I'm based out of San Francisco. I work in finance, so I still have a W-2 job. I work in financial planning analysis, do financial modeling, was working in investment banking, so very familiar with how Excel works and numbers work. And yeah, that's the sort of stuff that I enjoy. Started with the whole multifamily journey about 2, 3, 4 months ago. I have a portfolio of smaller residential properties. They are all in Huntsville, Alabama, which is also one of the markets that I'm targeting. Invested as a limited partner in a deal in Houston in September, 150 unit. So get the exposure from the limited or from the passive side.
He's in finance, so he's pretty good.
And appreciate that, Triana. And I also recently hired a coach who hopefully helps me accelerate my journey a little bit. So let me dive into Tampa, one of the target markets, and then I'm gonna switch over to the model. So okay, Tampa is one of the markets that that I'm targeting. I used to live in Tampa as well, so I'm very familiar with the market and sort of the surroundings, I guess. But just to give you a general impression about Tampa. So it's a pretty hot market these days. It's gotten really expensive there. And as you can tell by the population growth, it's continuously going up. If you look at Tampa proper, for example, we are almost at 400,000. The Tampa MSA is just huge with St. Pete, Clearwater, like a lot of places around, almost 3.2 million. So there's a lot of activity, and Tampa is projected to grow another 6.5% over the next 5 years. The crowd there is very diverse, very educated. They have some good universities there. USF, one of the biggest ones in the nation. So a lot of young crowd there. Bringing in a lot of diversified economy. I know that there are some companies that are moving in that are planning to set up headquarters. And I'm going to talk about that on the second slide here. I saw here a quote in one of the, as I did my research, that the population is expected to grow between 2000 and 2040 by 61%. So it's kind of actually crazy numbers there. Was voted #1 best city in the Southeast. There's a 7-to-1 new jobs to multifamily ratio, which I think is a pretty healthy ratio there. And overall labor force in the MSA is about 1.5 million. So you can see almost half of, which is, I'm not sure if it's correct or not, but about half of all the individuals in MSA are workforce or active labor force. As it relates to economy, very diversified. So if you look on the left, you have everything there from education, healthcare, government. They have a huge Air Force base there. Transportation, Tampa Airport is a huge employer in the area and also growing tremendously. We have healthcare there. We have Publix, supermarkets there, and also financial services. So that's something I think a little bit of a new trend and development. JP Morgan and Citibank moving in there. I know more and more people actually are being moved there to work for them. So that's a pretty positive trend there. Annual job growth was about 2.5%. Let's see what else. One of the fastest growing cities in Florida. I think that's a pretty interesting one here. 5th highest net migration in the US. USF, University of South Florida, one of the biggest schools in the nation. They bring in about $4.4 billion in economic impact. And then also there's a lot of tourism going on as well. So Tampa and all the beaches in Florida and Clearwater and St. Pete. But Busch Gardens, one of the big amusement parks there, about 4.1 million guests annually. And then lastly, a lot of transformation. So I mentioned the airport earlier. So they're pumping in almost another $3 billion to grow that airport. And I like to see that as well. I think that's always a good sign when they grow and invest in the airport or in transportation in general. There's good things bound to be happen. Tampa, downtown Tampa, a lot of development there. This is, I think, is a very interesting one. So there's about $3 billion development happening, driven by the owner of the ice hockey team there, so Jeff Winnick, and then also he's somehow affiliated with Bill Gates. So Bill Gates is involved in that market as well, which I think is interesting, and I just wanted to point that out here. And a lot of additional development happening. So I'm not listing it all, but just wanted to give you an idea. There's just a lot of growth, a lot of exciting things happening in Tampa. All right, so before I switch over to the numbers, kind of curious, any questions, any comments, any concerns?
Yeah, Bastian, I've got one. We've been seeing your first screen up that shows the first page of your underwriting summary. Is that what you had been meaning to show us, or were there some other slides about the market?
I had a presentation up here. You can only see my underwriting model.
That's correct.
Oh man.
That's okay. Can you just throw those like in the Tampa folder on the drive so that and I'll send the recording out to anybody that wants it, and then they can just match the slides up from the drive.
Yeah, okay, I'm sorry. I know my internet is a little spotty here, so I hope I'm gonna make it to this presentation here. So I'm switching.
Everything is real clear, and your voice is coming through real clear. It just, I think you have to choose a different screen or something on the share.
All right, let me try something else.
But if you're ready to jump into there you go. Yeah, now we're seeing your slide deck.
Okay, I'm sorry, I selected the wrong one. So I'm not going to go through it one more time. I will just send it out, save it out there, and then you guys can, if you desire, go through it. Okay, I guess now I figured out how it works. So we go back to the model. Okay, so let me give you a little tour of the models and how the numbers work. So the deal that I analyzed, it's not really one that I'm pursuing, but I just found that interesting. So it's a deal in Largo, which is part of the Tampa MSA. 24 units, so not too big. 1973 built. Yeah, and let me go through all the assumptions and the different things, and then I will show you how things shake out. So just so give you a lay of the land here. So that's sort of the starting or summary screen that is used in Justin's model. And I like that particularly because it's just, you have everything in one view. So you have all the data, all the numbers, all the metrics on one slide. And I will give you a quick tour on what all is on here, and then sort of how it impacts the rest of the model. So we have some property information here, as I mentioned, 24 unit in Largo. You can put in parking information, covered parking, carport. I don't have the information available, but if you want to, you can. Here is a section where you put in all your acquisition information. So here originally that was advertised as a 3.075 thousand or 3.1, I guess, million dollar deal. I'm putting the offer price right now at 2.7, but I will show you later why I did that. Right now, based on that offer price, purchase price per unit is 112,000, which I think is probably on the higher end, even for that market. Right now, I don't use an acquisition fee. Closing costs, I will show you in a second where those are coming from. Working capital, just a little bit of cushion. I put 25K in there. There is some value add component to that model. So I'm having that at about 158,000. Going in cap rate is about 5.2%, and then just estimated escrow closing if pursuing in March. In terms of renovation budget, so there's one thing I included in that model that was not in there before. So I was playing around with that a little bit. So I put in a functionality in that model where you can essentially choose if you have construction and if the construction is on the lighter side. If you don't necessarily want to raise the capital for it, there's a feature in that model where you can just flip the switch and see, what would the numbers come out to if I would fund those construction costs through your cash flow, assuming obviously you're cash flowing enough and cash flowing positive. In reality, I played around a little bit with that. It's not really making a big impact on IRR if you go either way, but I think it's just good to have a little bit of a comparison point in there. In terms of closing, I have closing costs at about 1%, exit cap rate at 7%. I think right now cap rate in Tampa is probably like 6.5%, somewhere in that neighborhood. So putting it at 7% after a 5-year hold. And then you will see IRR, project IRR comes out to about 11% using the 2.7 million sales price or purchase price. Equity multiple is 1.6 and cash on cash, 7.7. So not very exciting numbers, but there's, I guess, room to play with. Here you put in your acquisition loan information. So that's, I think, pretty standard. I'm not going to go through that. A nice feature in Justin's model is he has a waterfall structure in there. So you have hurdle rates in there. Right now, I have it starting at 8%, and then you can sort of make it your own with the GP promote in there. I found that extremely helpful, and not a lot of models that I looked at actually have that. So I found that really good. And then everything to the right here is just a little bit of a summary that you can just grab, I guess, and put in the presentation. But it's just a nice overview here. Again, here the purchasing details, here the renovation budget, and then it also calculates the return on your cost. It gives you some sort of break-even analysis here and how expense margins shake out. Gives you here the sale information. So again, exit cap, I assume right now at 7%. That's about a 0.36% cap rate expansion per year. Sales price comes out to 3.2. Gives you a value CAGR of 3.6%. So I guess CAGR, and the best way to think about the CAGR is value appreciation of the property is about, it appreciated by almost 4% a year if using those assumptions here. Here you have the IRR, you have the multiple. This section is pretty interesting because it actually gives you the breakout between the GP IRR and the limited partner IRR, which obviously is different, as well as the equity multiple. I think not found many models that actually break that out, so I found that very helpful. And also calculates the GP promote for you. And then down here, that's pretty standard, just the breakdown of the different sources at closing and the different uses of closing. So acquisition fee I have at 0% right now. Closing costs is that amount, and I'm going to show you in a second where that comes from. Working capital, construction budget I have right now in there, assuming I will raise the money for it. If I just to show you how it works, if I toggle and make that a self-funded or cash flow funded project, then obviously your construction budget goes to 0 because you don't need to raise that extra capital. And then so for the loan acquisition. So I'm just going to walk you through the different tabs right now and give you sort of my feedback. But any questions so far?
I got one question.
Yeah.
How did you come up with your? You probably tell me down the line. How you come up with your exit cap rate? That was an assumption.
Yeah, it was an assumption.
Okay.
Yeah. I mean, there's no exact science to it. At least I haven't figured it out yet. I'm sure there are more experienced individuals on this call who can probably answer the question, but
Yeah, most people just usually, well, I mean, I should say, for every year you hold the property, you basically adding 100 basis points to the exit cap rate.
yeah. All right, so acquisition costs, that probably looks familiar too. I would assume to a lot of people. I stole this from Michael Blanc's analyzer, so I like that a lot, the way he breaks it out. Just one thing I want to point out here is for the escrow. I'm probably being conservative there, but I'm just assuming 12 months of P&I, 12 months of taxes, and 12 months of obviously insurance as in escrow. I don't know if that's what lenders require these days or not, or probably depends on the lender, but just putting this in as a caution here. Okay, so now let me dive into revenue. So the way to think about revenue, or as it relates to his model, to Justin's model, is so everything to the left here, that is sort of coming from T12 and current rent roll, and everything to the right from there is sort of future projections. Going into current in-place rents. So this is just the breakout of the different unit mixes that this property has. So in this case, we have 6 units, 1 bed, 1 bath, 15 to 1s and 3 to 2s with the monthly rents. Down here, I added a section where you can put in your T3 or T12, whatever is most appropriate in that situation, and then also putting the current vacancy of 4.7. So that comes from the rent roll.
Bastian, is there a toggle on that T3, T12, or you're just putting static information in?
That's a good point. I could make that a toggle. You're right. Right now it's the static. It's just linked to, I think I used the T3 here, but that's a good point. Yeah, that's something nice to it.
And that's annualized?
Yes. Then on the stabilized rents, so here is essentially where you would need to put in your after rehab, after repair rent amounts. So this one here gives you a good indication on what the difference is between what's currently in place and where the rents would go. So on average, a $264 increase by unit. Ideally, at some point. Down here is the section for all the other income items, so laundry income, late fees, and all of that. I'm deriving that from the T3 or T12 as appropriate. For this one, I noticed that RUBs are really low compared to what the water charges are in total. So I double that for now because I feel there's some opportunity to increase that along the way. What else? So that's sort of it in terms of input. So now I'm gonna go through the different growth assumptions, and then I show you one feature that I particularly like about Justin's model that I have not seen anywhere else so far. So focusing on this section here for now. And let me know if I go too quick or if I'm not clear, please. I want to make sure that this is helpful for everybody. So market growth rates, market rent growth, and other income growth. For the first year, I put that at 0 just to be extra conservative. I guess that's my little COVID cushion here. Putting that 0%, and then starting the year 2, I grow that by about 2% annually. I put my vacancy at 10% for the first year, although right now vacancy is 4%. Loss to lease is 3, concessions and bad debt is 2, and then just kind of decreasing it from there as the years move along. The nice thing about Justin's model is that he phases in the rent increases. So as you finish up renovating these units and start increasing rents, he has a nice feature where he phases it in over time. So what you can do here is you can indicate, so at what time do you want to start renovating units and ultimately increasing rents, and at what time period do you estimate to be completed with that? So in my case, I said, okay, after 3 months of holding, I start renovating and increasing rents, and I expect to be done in, after 18 months. And I want to show you what that essentially looks like. So to the right here, here's some formulas in there, and I massaged it a little bit, but overall, I think that's a really good approach where he slowly, just focusing on the percentages here, he slowly phases in the new market rents, the higher market rents, as units become available and completed, where starting in month 3, about 6% of the units or 6% of the market rent is phased in, and then ultimately lasting until month 18, where we say, okay, at that point we're at 100%.
Bastian, is that a manual input, or do you actually have a sheet for inputting rent roll and it pulls the data from there?
Yeah, I have that all sort of linked up.
So it's pulling data from the rent roll?
Yeah. So, well, you only need the starting point from, let me back up. All you need is the current rents in place. That pulls from the rent roll. What the model does is, based on my assumptions over here in terms of rent growth, it grows that number every month. So in the first year, it doesn't grow, but then starting from there, it grows by 2%. And it does the same with the stabilized rents. Those grow at the same rates. So all you need is the initial input, and then it just does the math from there for the future periods. Any questions on revenue before I move on to expenses?
I have a question. Don't you need to know how many leases are month to month and how many are set to expire so that you can start turning those units to figure out? Yeah.
In a perfect world, yeah. But I mean, again, these are just high-level assumptions and high-level calculations that I do. I mean, the rental that I have didn't really indicate any month to month, but if you want to be 100% accurate, you probably need to factor it in as well.
Thank you.
Okay, so let's switch over to expenses. So let's start with the T12, the operating expenses. So those are really straight coming from the T12. I'm not going to go through each of the individual ones, but currently, based on the T12, it's about a 42% expense ratio based on the effective gross rent. And over here in this section, that's using my assumptions that I have. And I'm going to quickly just go through those expenses and give you my thoughts, how I think about it, I guess. So the management fee, I put at 8%, which is slightly higher than what they're showing at T12, just to be a little bit more conservative there. Legal expenses, they have it at $55 per unit. I was just assuming, we are in the eviction moratorium. There were probably no evictions happening over the past several months. So not knowing exactly what happens in the future, I just increased that a bit. So usually I'm using an assumption of 150 per unit. So I brought that up to 3,600. No personnel because unit size is just too small. The general and administration, they have it at 8,000, but they had a lot of crazy stuff in there, like travel and all that. I don't think that's necessary. I don't know if the owner just used it as a pass-through for his personal stuff. But right now, I have it at the range that I use is between 50 and 150 per unit. Given it's on the smaller end in terms of unit size, I use the higher assumption, so put it at 150. Marketing is pretty much on par with 40 unit versus 50 unit. Repairs and maintenance is at 463. The range I use is about between 350 and 550. And again, same logic, given the small unit size, I go with the higher end just to be a little bit more conservative. Turnover, they didn't have anything specifically included in their T12. I'm just usually assuming 250 per unit. Contract services are, my range is usually 150 to 200. It seems a little higher, so I opted with 300, just going a little bit higher than my usually range. Electricity, gas, trash was not specifically called out, so I just had that all in water and sewer. They have 640 per unit. I'm using 650. Real estate taxes. So one word about real estate taxes, another feature that I like about this model, it actually does the calculation for you. So if you look at this little box here, if you know your millage rate, if you know the percentage of the value assessed, and then how the appraisal works or how the property values work, that model calculates the property taxes for you. So in this case, in that state or in that county, they're using 75% of the purchase price as the assessed value. And the millage rate is here, the 20.4220. If you put those all in, it gives you the math. It comes out to about 41,000 a year, which is pretty on par with the current taxes. Also knowing I'm using a slightly lower purchasing price, so as I'm increasing the price, obviously taxes go up as well. But I think that's a pretty nice feature where you can verify how you're doing the taxes. And then just to finish up here, insurance, I kept that flat to the T12, and then I put in some capital reserves of 250 a unit. Overall, I'm assuming that the expenses are going to grow about 3% per year. So 3% expense growth versus a 2% revenue growth, just to being extra conservative there. And then for the taxes, I just assume a 2% increase every year. So that's how the expenses work for this model, at least. Any questions?
Bastian, do you know if does this have the ability to use pivot tables so that you could pull data, just upload an entire sheet, say for the T12, if it was in an Excel format? Could you just upload the entire, make a connection so you don't have to manually input the data?
Yeah, I mean, you can do it. You have to just make sure that whatever T12 or whatever you're using has the same format. I think it's more like a formatting issue as opposed to a importing issue.
So I know that CoStar and Yardi and some of the big boys ask for their T12s and stuff to be uploaded in a particular format. So if we knew what that format was, we could probably ask the broker to send us this information in that format, and that would potentially speed up the underwriting.
Oh yeah, absolutely. Yeah, that's totally doable.
But you're saying doable, it's not already built in. It's something that you or somebody with the knowledge would have to modify the underwriting sheet to do that.
Yeah. I mean, I'm eyeing a little bit on the computer guys here. I don't know, Davide, if you're probably a little bit more familiar with that than I am, but I'm just a very Excel-based person, but I'm sure there's a lot of importing that we can do from other sources.
Yeah, it's a matter of setting the format. I mean, we could even parse from a PDF file, but it has to be in the same format. I think if it comes in Excel, it's even easier.
If they can provide an Excel file and they're always using the same format, I mean, it's very simple to just link that up, and then all you have to do is to change the source links, and it's like a matter of like 5 seconds to update. Okay, so if there are no other questions here on expenses, I'm just going to finish up real quick. So now what does that look like in terms of financials? So there are two views that we have here. One is the monthly view and one is the annual view. I'm going to focus on the annual view a little more, but I just want to show you one addition that I did to the model for the monthly view. So the way this model works is as you look at other income, it asks for per unit assumption. So if you go back to revenue, and I hope I'm not going to confuse you all now, but essentially the way other income works is you put in your assumptions for all these individual items on a per unit per month basis. So that means per unit, per 1 unit is essentially spending about $12 a month on laundry, and so on for the other items. So one of the shortcomings that I noticed with that model is if you use that approach, that per unit approach, and you use the total number of units, so in my case 24, you always assume that the property has 100% occupancy, which is probably not always the case, right? And what I included here is something that I call, and I don't know if it's a thing or not, but a vacancy adjustment. So meaning, in this example, if the property is occupied 100%, then yes, we would probably get the $287 a month for the laundry. But because we have 2 vacant units, well, that leaves us with less revenue. So that's the adjustment essentially that I make here to account for the units that are not occupied. I'm probably a stickler on that a little bit, but when it comes to income, I would rather be conservative and estimate a lower income. I probably need to do the same thing for expenses, but in this case, I'm okay with overstating expenses a little bit, just for the sake of being a little bit more on the conservative end. So now, as it relates to the annual cash flow, so here are the numbers. So I put in some, just so you have some reference point, I put in the physical vacancy, economic vacancy up top, where you can see I'm sort of like slowly phasing that out. I put in a T12. I always like to have something to compare to. And ultimately, if we go further down, I also put in the expense ratio. So as I mentioned earlier, right now the T12 has a 42% expense ratio, and I'm bringing it up to 49, and then slowly decreasing it over the years. Let's see, and down here just some additional calculations based on cap rates, but I'm gonna show you something else in a second here. As I mentioned earlier, Equity Waterfall is in here as well. I'm not gonna go through that, but I think that's very helpful, playing around with the different shares, the different splits. Here's how that is calculated. I think that's pretty straightforward. Here's another feature I like about this model. It's the construction budget, where you can go really granular, budget the individual items that you're trying to fix, and then put a start date and an end date to it as well. So some more flexibility there in terms of how numbers are allocated, and also it helps when you try to self-fund the construction, gives an indication how much money you need in each of the individual months. You can do it for interior construction and then exterior, or I guess other way around. And I also have contingency in here. So I always plan with a 10% contingency just to have a little bit of a cushion. Okay, then let me show you. So here's just a little side note. I found that to be interesting as I was digging through that. I played around with IIR a little bit, and there's one thing I noticed. So a lot of the models are, the way they're calculating IIR, they're using the annual numbers. But the beauty about IIR is it depends on when you receive those payments, right? So usually in a syndication, at least the ones that I participated in, payments are usually on a quarterly basis. So you get the payouts earlier. You don't have to wait a whole year to get it. You get those payouts earlier. Depending on where you get the payouts, IRR is different as well. So, and I just want to give you that as an example, and you probably already know about that, but that was sort of like a interesting fact for me. If you receive the payments, and the example that I have here right now is it's always the same annual amount that comes through. So if you receive the payments annually, it gets you to in this case, a 10.7% IRR. But as you receive those payments earlier, let's say quarterly, IRR starts to improve. Here it's at 10.95, and then if you get monthly payouts, it's at 11. So most of the models out there, what I noticed is they are understating IRR a little bit because they're assuming that payouts are annual, versus I think in reality it's probably payouts are sooner than annual. Some are quarterly, some are monthly. So just I think an interesting side note here. I'm a very visual person, so I put in a few graphs, and I'm still building it out, so this is not complete yet, but just some data points there you see how those are trending. So I put vacancy up here. I have blue the economic vacancy, I have orange physical vacancy, and then you can see how I slowly I start out with high vacancy in the first couple of years, and then slowly start to phase those down. I have the current physical, I should probably specify the current physical vacancy in there as well as the red line at 4.7. So shows you that I'm definitely being more on the conservative end, trying to stay above that, just to have some room there in case something unexpected happens. I have the NOI, the trending of the NOI in here, and then also down here, it gives you an indication on how the net cash flow shakes out over the years. Again, it's assuming a 5-year hold. That's why you don't see anything beyond 5 years. Orange gives you the indication of cash on cash return, and then you're going to have the sales proceed at the end of the 5th year here. And then just to round this up, put a little bit of a sensitivity analysis in there, and I found this actually very, very helpful and very interesting as well. So these are all IRR and sensitivity. So the first table gives you an indication on terminal value, so essentially exit cap rate and holding period. So right now I'm at a 7 cap with a holding period of 5 years. So it gives you an IRR of 11. And now you can start playing around with the numbers. If you hold that property longer, obviously you're going to increase your IRR. Or if you use different cap rate assumptions, you can, increase or decrease depending on which direction you go, your IRR as well. So it gives you a good indication on how markets could turn out. Down here, again, IRR sensitivity, it gives you an exit cap rate here. And then the top part is essentially what gives you, so 0% means if you hit your NOI forecast, you're not going to have a change to your forecast. But that's assuming your forecast for the last year comes in 2% below, or 4% or 6%. It obviously decreases NOI, and with that, it also decreases your IRR. So these are just different scenarios that you can play out. If you're exceeding your forecast, you're coming out with a higher IRR here. In this example, 13.46%. So just different scenarios here. And then lastly, what I want to show you is, and that's probably more helpful if you still in the negotiation phase. It shows IRR based on purchase price and based on holding period. So right now I'm assuming purchase price of 2.7%, holding period of 5 years. And now you can play around. If you want to achieve a certain IRR, let's say you want to have, you're not going to look at anything below 15%, right? So you have to 15% and a 5-year hold. So you can gauge here where you need to be with your purchase price to hit your target. So in this case, you're probably looking closer to 2.5%, 2.5 million to hit a 16% IRR, or you can also play with the holding period. So just additional sensitivity to play around with. All right, with that, that sort of concludes what I all wanted to show you. Curious, any questions, any feedback, any concerns? I hope I didn't go through it too fast that I confused everybody.
This
Hey,
is awesome.
Bastian, I really like this sensitivity analysis table. Is it fluid? Does it depend on your parameters? Where do you input the parameters for sensitivity analysis?
So I mean, it's all automated. So just to
Okay.
give you, I guess, an example, if you just change the purchase price to 2.5 million, we go back here. So you have to manually hit F9 because otherwise it recalculates every time. It slows down the spreadsheet. But if you have it calculate, then it slowly updates all the tables. So it's live linked based on all the inputs in your summary sheet.
And Bastian, this was in the original model, or did you add this?
That's so these are all things I added to it.
You added this? This is awesome.
Yeah.
Yeah, it would
Bastian,
be nice to have a vacancy rate too, but this is great. Really good.
Bastian,
Yeah, there's a lot of different views you can create. Yeah, go ahead, Tybo.
yeah, I was just going to add a little bit actually. It's a wonderful presentation. I love the breakdown. I know this is just a first version I can see, but I was just thinking about it. Is there a possible way to like put like a minimum investment criteria? For example, if I just want let's say you know, a particular percentage cash on cash every year or whatever, and I put it in, and if my calculation goes below my target criteria, it like flashes red or flashes blue or something like that. Is it possible? How can we do that? Sorry, I'm not good at Excel,
Yeah.
but you know, it's fascinating.
Yeah, no, totally. It's totally doable. I was actually thinking about, and I'm still playing around with it, putting a sensitivity table in there where it gives you IRR on the left, and then average annual return on the top, and then based on which returns you want to hit, you can sort of select the purchase price.
Oh,
You
yeah.
know, so if you want to have 15% IRR and 12% annual return, you can sort of pinpoint, okay, where would the purchase price need to be to achieve that?
That's good.
Bastian, would you mind showing the equity
Yes.
waterfall?
Yeah. I don't know if I'm in a position to walk you guys through it because I'm not very fluid on that.
Okay. I can see okay.
Hey, Bastian, I came late, but I appreciate all these different tabs. I really like it.
Appreciate it.
So I'm interested in everyone's initial impression of this model compared to the SDA and or the SDAs that have been modified.
I think this is fantastic. I really love that sensitivity tab, Bastian. I think you knocked it out of the park with this. This is really good.
Yeah, I like this model too, especially the construction budget. And I actually have my own video part. I did watch 4 hours of Justin's presentation on this model. And I still got 1 hour left though, but I do like this model.
I won one.
Hey, Bastian, which of the tabs is your tabs? Is it the sensitivity and the graphs, and everything else comes with the, I guess, Justin's model?
So it's so yes, sensitivity and graphs is definitely mine. I made a lot of changes in his tabs as well. So just to give you some idea based off memory here, and I might maybe a little bit off, but so I think I added the loss to lease. I added concession. So his was not very granular. I tried to make it a little bit more granular. I changed some of the functionality in his model because I wasn't quite agreeing with the way it flowed through, but I think it's probably minor, not a big deal. Yeah, there are several things I changed around. I did the vacancy adjustment because what I tried to explain earlier with these vacancy adjustments here, because I was just not quite agreeing with overstating the revenues essentially the way it
I like that. I saw that.
originally was.
That makes it, that's more accurate.
What's in the checks
Right,
tab?
yeah.
What's in the checks? Is that an errors checks tab?
Yeah, it just gives you an indication if there's anything not tying out throughout the model, which is very helpful.
Okay, so that just gives you some alerts there. Okay.
Yeah.
So Bastian, I know that and Justin has several different models, and my eyesight is horrible. Which of his models is this one based on?
Well, I think he calls it, what's the file name? So he calls it Multifamily Acquisition Model. I don't know if that's the official name or not.
Yeah, I'm pretty sure that's it.
Yeah.
Great work. Great work.
Appreciate it. Yeah, I mean, I'm more than happy to share it with you guys. I'm still not 100% happy with it, so I'm still adding to it and refining it. But I'm more than happy to, if you guys see value in it, more than happy to share it.
I'd love it.
I love it too.
Yes, I definitely love it. This is good. This is good.
Absolutely. So what did you end up doing with this deal, just out of curiosity? Did you end up making an offer on this, or?
No, so for me, the numbers didn't shake out. If I go back to the 2.7 that I originally had, and maybe my underwriting was also conservative. I could probably could have been a little bit more aggressive in certain ways, but if you look at 2.7, so this price was 3.1, 2.7 is what I just put in as a placeholder for now. Even using 2.7, it gets you to 11 IRR and 8% average cash, which I think is a little low. So I did not find it to be a good deal, to be honest.
Right. With this model, is there kind of a quick way to analyze a deal with this? Is there kind of a, sort of like Michael Blanc's 10-minute analyzer? Is there can you quickly shake out the wheat from the chaff with this, or is this more of a detailed analyzer once you kind of got through it smelled, it made it to the first round? This would be kind of a second round analyzer. Is that?
Yeah, it's more detailed. So it takes a little bit of time to update. It's not a quick one, to be honest. But it could be, right, depending on how the source data, where the source data is coming from. If it can be fed in very quickly into the model, it can be updated fairly quickly.
And I think Justin has one of his models is like a mini model, so you can put in some key parameters or numbers, and it's not quick, but it's more of a mini model to kind of tell you want to dive deeper into doing the full analysis. Yeah. And that's on the drive too.
And it wouldn't be very hard to integrate an additional tab and put, literally just whatever we like and just add an additional tab. So if everybody really liked the first page tab, 10-minute tab that Michael has, you could just add it on.
Yeah, and that would make a lot of sense, just to keep everything consistent. So there was just a really quick way to, cut through the noise and and then do a deep dive into the ones that made sense. And that could,
No.
like you said, that could be as easy as just cutting and pasting from Michael Blank's.
Yeah, and Bastian, if you upload that onto the platform, we already have Justin's model up there. So just kind of give it a little twist, put your twist on it, Bastian's, version of, or put your initials on it or something so that we know it's your model. And please, everyone, remember to work from a copy.
Hey guys, just a general question. So Bastian, your assumption was that your entry cap rate is actually lower than the average cap rate. Is that typical to do that?
You mean my 5.2 compared to
The
exit?
six? No, so you said that the average cap rate is around 6.5.
Yeah.
Is that normal to have a lower cap rate than average market, or do you base your offer price on the average cap rate?
I'd probably let somebody more experienced answer that question.
Well, the cap rate is
Okay.
you're paying more for the property. So you want to buy it at a higher cap rate and sell at a low cap rate. So if the market rate is 6, you want to get it, above that. So your price is going to be lower. And you want to sell on a lower cap rate.
Your
Is the-
entrance cap rate may not even, I mean, it doesn't really matter that much because you could have a much lower cap rate than what's in the market upon entry. But because of your business plan and what you're going to do with the property, I mean, that really matters. So as long as the numbers work, entrance cap doesn't really matter. But the
Trina-
exit does. Exit, you want to know for sure.
Trina, is the question regarding cell 2I? And if so, Bastian, that's a calculated cell, correct? Based on NOI
Correct.
versus the purchase price.
Yeah.
So essentially, that's basically what that's saying to me is that they're asking a higher price than the prevailing cap rate.
Yeah, and the way the OM was obviously right on market, but they were very aggressive with their growth assumption, which is just overstating cap rate to a degree. So I think this is a more realistic cap rate.
So Trina, are you following that? Did that answer your questions, or would you like a little more detailed explanation?
No, I know, I get it. So looks like we're just at, yeah, so the going in cap rate is not that important. It just gives you a ballpark of whether or not price is fair for that market and submarket. Is that correct?
That's correct.
Okay, got it. And then
So-
another question I have is when talking to brokers, they have this thing called a gross rent multiplier.
That's
Yeah, we don't usually use that.
Yeah, it's a
metric.
more archaic number that's used usually on smaller property sizes, and in bigger deals, it's not usually used. Although some of the lenders, when they underwrite, still use it, but they don't. It's usually not presented.
Okay. And last question, they also talk about return on equity for deals, and they use that as a guide for when you should sell.
Well, so the way I learned it, I think that's more a metric that I hear more often in the smaller residential properties, the single families and the duplexes. I don't know if and I let somebody else probably speak to that, but I've never really heard it in association with multifamily properties.
I hear it a lot when I talk to family offices or private equity, but it's typically not a metric that we calculate. The closest thing to it is equity multiple for us, I guess, I don't have a good answer for you how they're calculating, because their numbers are all over the place. And when I ask them specifically what calculation they're using, I usually get a very nebulous answer.
Okay, that helps, guys. You did a really good job, Bastian. Thank you.
Appreciate it.
So just, I want to say one more thing on the cap rates, Trina. 100% what Mark said, your going in cap rate is sometimes irrelevant because it's not the most, it's just a rule of thumb, something you can look at, but it's one of the least important things to look at going in cap rate because it's entirely a calculated number based upon what you're willing to pay versus what the current NOI is. So your business plan, if this is a property that's empty, you know, and it has no NOI at all, then what's the cap rate going to be? So that's why it's really kind of unimportant going in. But what you do need to know is what there's 3 cap rates to me that are important. What the current market cap rate is, what the historical cap rate is, and what exit cap rate you're using on your calculations. Because what Pat said is true, that you want to buy at a high cap rate and sell at a low cap rate, but that's not how you normally underwrite deals. You normally underwrite deals, your exit cap rate is higher. And a lot of people will say add 10 basis points per year of hold. But if you really want to be conservative, I've seen certain groups that underwrite on a 5-year hold, typically 200 basis points, which is very conservative.
Hey, Bastian, where do you put in the existing, not, I guess the market cap rate, not your going in cap rate, but the market cap rate in order to get those, I guess, as you hold a property, you're putting in whatever, 10 or 20 basis points per year. How does it count? So I see the exit cap as 7%.
Right.
Where is that drawing from? Like what?
It's a straight input. I mean, you can build a logic in that you wanna increase that the current market cap by X amount per year. It does not have it right now, but it's easy to add. But right now,
Okay.
the exit cap is just a manual input.
Gotcha. Yeah, it looked like it, well, yeah. It was in blue, so I figured it was calculating by itself what the
Yeah,
cap rate is.
I think everything in blue, I have to verify. I think everything is blue is manual input, and everything in black is a calculation. I guess I should have mentioned that. Yeah.
Can you go to the sale detail all the way to the right and then click on the exit cap up at the top? Top all the way to the right, sale detail. Yeah, right there.
So it comes from this one down here.
Okay. Okay. All right. All right. So that's the manual. Okay.
Yeah. But I will add that. I like that.
Wow.
Any other questions?
Yes, I have a question. Where's the disposition fee and asset management fees?
So asset management fees I have right now here at 0, and disposition fee, I don't know if I have it in there or not. Oh, I do. Well, closing costs. I don't think I have a disposition fee in here. I have an acquisition fee. That's maybe worth adding, yeah.
Bastian, just one thing, it's just very small. On the construction budget, there should be like a soft cost added on, which may be important or not, but you know, it's good to have that.
Where is that? Sorry, Tyler, where are you?
On the construction budget.
Construction budget? Okay.
Yeah. That's the tab, the construction budget tab. The tab itself down. all the way down, very near the depth and IRR. Yeah.
Sorry,
Not,
I'm not.
not
On the
on this,
tab.
not on this sheet, Bastian.
Not on
on
sheet,
the-
on the
the
tab.
tab?
Yeah.
There
on the
you
tab,
go.
Yes.
Oh,
Yeah. Okay. Good. Yeah. There should be. I'm seeing a lot of hard cost, but I'm not seeing a lot of soft cost. So it may not be important, but it's something that could be added probably on other versions. Depending on the kind of project you're doing.
What's hard versus soft cost? I guess I'm not familiar with the terminology.
Okay, like for example, your hard cost is like the cost of your concrete, your cost of your windows, wood trim, and all that. But when you talk about soft cost, you talk about like design costs, landscaping design. If you're paying your consultants, or it depends on the kind of project, though. But if you're doing a little bit of things like design, things like you're getting permits and approvals and those kind of things. So maybe that could actually add up to the construction budget.
So is the difference, one is hard cost materials versus soft cost model
versus
labor?
Yeah, more like the soft cost is more like the intellectual work kind of.
Got it.
Yeah, that's the best way to
Consulting.
put it.
Yeah, consulting and labor maybe, or consulting.
Yeah, more of consulting. I don't know if this seems to be like more of a value add, but it may not be needed, but it's something that could be an extra tab just in case.
Okay, cool. No, that's a great one.
So Tau, that's an area that you could add a lot of value to the group and to the platform with your construction experience, maybe bring some additional tools for scope of work and for even replacing, construction budget analysis using some of the industry standards.
Yeah, I could try. I could try any way I can add value. So what I try to do, any way I can.
Well, if there's no more questions, Bastian, this was a great job. Thank you very much. It not only very detailed, but I'm very happy that everyone got to see a different model. So that was exciting. So thank you.
Yeah, my
Thank you,
pleasure.
Bastian.
Absolutely.
Great
Bastian,
job.
thank you very much. It's amazing. I love the detail in there. This is good. Thank you very much, Bastian.
Appreciate it. Thank you all.
Great job.
So, quick question, Jim. How often does this hold? How often do
We
we
have underwriting every Thursday, and you get to sign up for presenting, a deal that you've worked on. It could be a real deal. It doesn't have to be a real deal. It can be a deal that you're pursuing. It could be a deal that you've already closed on, and you just want to share, your thought processes and your
Okay.
business plan. So yeah, it's pretty wide open at this point.
Okay, sounds good. Well, lots of experts here, so I'm going to keep my mouth shut, I guess.
So hopefully, we have a good turnout tomorrow night. I thought that there's been a lot of activity on the Slack channel and not so much on the actual drive where most of the real work should be taking place. So I think there's a lot of people that haven't seen what's on there yet. So we decided to have that, and it might need to be a regular thing because I've noticed there's quite a number of people on Slack that are not even on the platform, on the actual drive. So I'm always open to suggestion. And as you guys know, I'm not the smartest tool in the shed. So depending on you guys to help me figure these things out. And with that, I hope to see some of you guys tomorrow night.
Okay, take care, guys.
Awesome.
See you guys.
Thank you, Jim.
Thanks, guys. Talk to you later.
Bye-bye.
Bye.